Hello, and welcome to yet another episode of Edelweiss Money Konnect podcast, your go-to place for collecting investment gems from stories, conversation, and book summaries. In today's episode, our CEO and MD Radhika Gupta and Dhirendra Kumar, CEO of Value Research, throw light on the importance of asset allocation, simplify balanced advantage funds, international funds, passive funds, and a few more mutual fund categories.
I'm Radhika Gupta, Chief Executive Officer and MD of Edelweiss Asset Management. And it's a Friday evening and it's a time to have good, honest conversations about mutual funds. And that's exactly what we have planned for you today. So today, without taking much further time, I want to welcome our very special guest. I'm so delighted he took the time to join us today. Dhirendra Kumar actually needs no introduction, but I will still take the opportunity to do an introduction. Dhirendra is one of India's most well-known faces on mutual fund. He is, of course, the founder and CEO of Value Research, India's largest leading independent provider of MF information and research. Many of you have used Value Research. I doubt there's anyone who hasn't heard of it. And over the last 3 decades, I think he's gained a very unique perspective on not only the asset management industry, but how investors behave. And he's interacted with now thousands and thousands of investors. So there are decades of experience across the length and breadth of the country. He's the editor of Value Research's popular website on mutual funds, valueresearchonline.com, the monthly magazines Mutual Fund Insight and Wealth Insight. And of course, he's a popular columnist. So thank you so much, Dhirendra, for joining us. We are delighted to have you today.
Thank you, Radhika, for having me here.
So Dhirendra, I want to kick off this conversation by asking you a slightly more historical question. Of course, Value Research is one of the most widely used websites by advisors and investors. You know, people rely on Value Research insights, and even AMC people, I think, look forward to reading it. But tell us a little bit about this journey on how Value Research started.
Oh, it was, an accidental start of our journey. It was not a very planned affair. I did not go about implementing a business plan. It all started in 1990, the year I graduated from my college. And that was, those were pre-internet days. Economic Times used to be priced at 10 rupee 30 years ago. So just to give you, 10 rupee in perspective, the cost of living in Delhi for me was about 600 rupees a month. So, just to get so it'll also give you a sense of compounding and cost and things like that. But those were the days. And so I started in 1990, and I was in a college where there was not much to do. So, I was clipping the newspapers and just keeping it. I can say that, the root of Value Research lies in boredom. I didn't have much to do. I was organizing those clippings. And after my 3 years of graduation, I thought that I'm sitting on a vast resource of information, which was very well organized. And mutual fund was a very small part of my filing system. So I just collated those. In 1990, there were 8 mutual fund companies, UTI, LIC, GIC, and 5 bank-sponsored, LIC, SBI, Can Bank, and PNB, and Bank of India. An Indian bank. So there were 8 mutual fund companies. They were all public sectors. SEBI did not exist. The rule for mutual fund NAV was that, they were only closed-end funds. And mutual funds were very popular then. In fact, I would say that if I look at it in the relative financial landscape, they were much bigger than what they are today. But that apart, these 8 mutual fund companies, they were running about 80 funds, and there was no centralized source of information. And so I just compiled it. The start of Value Research for the Excel file on all mutual funds compiled out of newspaper clippings. And then 1990, I was able to put together a scorecard based on, because these closed-end funds, they were listed in the market. And there used to be a NAV, which was 3 months, calculated every 3 months, and disclosed in some goddamn newspaper every next 2 months. It normally used to be some, obscure newspaper. So that information, limited information compiled and organized in a nice way in an Excel table was my first product. And while I was in my, just out of college, I was able to find a customer in Economic Times. I started the mutual fund scorecard in Economic Times in around 91. And that was the start of it. And then, because it appeared and it had a wide, it was able to grab a wide audience, I was able to source more information. Portfolio information was very scarce. So I was, that was the start of the journey. And soon after, so initially I didn't have much of a plan. But then I realized that the work which I am doing is of, far greater implication, and it's useful. It is useful for my neighborhood. It is useful for my parents. It is useful for everybody who earns, because in those days, mutual funds, it looked like, I have just discovered something which had a massive appeal. It has taken much longer for it to happen, or it is beginning to happen, or I would say that it's still in its state of infancy. But 30 years ago, it looked like a very promising thing, because market was otherwise not accessible to anybody. Mutual fund was. Market was not what it is today. Brokers won't entertain you unless you are very well heeled. So mutual fund had a very different context. I thought that I have been able to, and I was able to become a very viable entity with my lowly work as an individual in my first few years. And then I went about formulating the long term. But, not much could have been planned, because most of the big things that have happened thereafter could not have been anticipated.
Actually, there's sort of tremendous, and you've been very humble about it, but there's tremendous business advice in the whole thing. I mean, I learned that you started the business before SEBI was born, but you also emphasized the importance of data well before we started saying things like data is the new oil and all these things. I mean, it's a business built on organizing data well ahead of its time. Now, I want to ask you a question. There are so many of these ratios out there for mutual funds. We are all very quantitatively driven, Sharpe ratio, standard deviation, trainer ratio, etc. And I have always wanted to ask you that, as someone who works with this data, for investors listening to this, what are the data points that they should look at? What are the few data points they should look at? What are the points they should ignore? How should they use this information to their advantage? I actually don't think we use all the information out there to our advantage.
Yeah, all this information, is there. There is a problem of plenty, and there is also, there is a tendency for something to be, to be jargonized, and a lot of people actually try and make it look sophisticated and jargonize things so that they become relevant or useful. But that the way I look at mutual fund analysis is pretty simple, and that should be something which every investor should follow, which is when you are looking at an equity fund, my starting point of any analysis is, how has this fund done in a full market cycle? And can I see it in a graph? If a fund has done little better than the market, or its peers in a rising market and fallen little less than that is my starting point. And we have formulated this internally. This is the starting point. Then I go and look for, has the fund manager been around for that long? Because can you attribute it to a person? And then I go and delve a little deeper in terms of, what is the stated objective? Do they follow a policy? And how sustainable or robust it is? And then if you are able to do this, then you will be able to filter the funds, which is, to be able to filter a set of well-performing fund, because, all of us start with the starting point is chasing recent past performance. And chasing recent past performance, whether you chase the last 3 months or whether you chase last 5 years is one thing. But splitting into these two components makes it, you are able to evaluate things a little more closely. Then I try to look for, see in a portfolio that whether it is accidental or whether it is a design, and that design can be captured in the policy statement of the, what the fund manager has set out to do. That is not the stated objective, because stated objective is pretty vague. Even after classification, it is pretty vague that, a mutual fund will invest in smaller companies and look for capital appreciation. But how do you go about doing things? And what you claim, and just not fancy word, but, validate it in the portfolio that it is actually being followed by just 1 or 2, 3, for example. That is all there to it. The rest of the things, I think it is all bonus. Look for it. Everything is post facto. All that you see is past. And these are the only things which you can see that, if there is a process to it, It has the possibility of being replicable in future too. Alpha, all the modern portfolio theory, alpha, Sharpe ratio, Trenner ratio, R squared, and standard deviation, and you name it, information ratio, whatever. These are all nice things. Many a times these things are invented by people to impress customers, and it may not be a bad thing if you are able to convert a non-investor into an investor if it is getting charmed by this. But even for a practice, I don't think it is a sustainable way. Because the only way you can impress a customer is when you guide him, hold his hand, and hold him hand through his journey of investment with a lot of anxiety, and that requires earning his trust, not by spitting jargons.
In fact, I think, Dhirendra, I sometimes say that the process of mutual fund analysis and the use of these ratios is becoming more of an art than mutual fund management. I mean, but if I could to summarize for our investors what you said, it's essentially looking for someone who's following a process. Second, I think, which you said and, is not often talked about, a fund manager who's been around. I think we don't give enough weight to fund manager longevity. And you made a point that that's very important. And then finally, when you look at performance, you're saying, look at it over a cycle and see that in the good times, you've done a little better than the benchmark. In the bad times, you've done a little worse than the benchmark. And I think you put it in a very, very simple way.
That itself takes care of most of the things.
Yeah, so that I think you're saying takes care of 90% of the things. And then, this analysis paralysis of 3 months and 6 months and 9 months and 8.5 months, then I think goes away. Now, you touched upon another point, which was categorization. And, there are various categories of MF within debt and equity. In fact, in my opinion, debt has way too many categories. I'll be curious to hear your opinion on some other day. But how should an investor select the right categories for himself? Is there some checklist or framework that you can follow and then say, okay, these are the categories I have to look at? And maybe you can talk about both equity and debt.
Yeah, absolutely. Value research, we think very hard in terms of simplifying things for investors. And yes, there are 32 categories in the open-end fund category. Of course, 32 is looking only at the face of it. There could be multiple categories hidden within a category. For example, index is a category and it can have many of them. It is not taking into account all the closed-end funds which are permitted which is also permitted. Different kind of ETFs can be had, which could be a category in itself. So in that sense, I would say that there is a problem of plenty, and there is a big clutter there. But most investors can do without these 32 open-end fund categories that we have. My sense is that even a sophisticated investor's needs are very easily and nicely and comprehensively met by just 4 or 5 kind of funds which they need to own, and they can ignore the rest. For example, all your long-term investment, and long-term investments meaning 5 years and more, and an accumulation vehicle, most investors' needs will be met by a balanced fund or a balanced advantage fund or a tax-saving fund. If you are investing, if your potential to save every year does not exceed 1.5 lakh rupee, and if you are a taxpayer, tax-saving fund will do the needful, and that is all about it. You save the tax, you grow your money, and end of the story. If you can save little more, if you have more investable surplus, then move to a multi-cap fund. If you are a first-time investor, not a taxpayer, and nothing else, scared of the market, want to earn little more than what the bank deposit gives, and it's your long-term money, a balanced advantage fund or a balanced fund is good enough. It is a steadier take on growth, and growth is what you have to bet on. And the whole rationale behind this principle is that it's a general bet on economy. We will be better off in next 5 years, and the businesses will benefit. Businesses will earn more than their fixed income than what fixed income can produce, and that is the rationale for equity investment. But it will not happen in a nice smooth line every day. So have this at least a 5-year time frame. So these 3 categories, a multi-cap fund, a tax-saving fund, or a balanced advantage fund or a balanced fund, can actually take care of most investors' even sophisticated needs. Then rest of the equity category you can easily ignore, but you can supplement it with a small cap if you're getting. But my problem is that this sounds too simple, and many a times investors want that If it is too simple, it's not good. It has to be complicated for it to be, useful or, impressive. That might be one temptation. Many other times people are chasing performance, because many a time, you have to really see that what are you looking for. And what you're looking for is superior inflation-beating return over a sustained period of time for your accumulation. But most investors are actually looking at chasing the best fund. And chasing the best funds drives them in different direction. Most of the time, the best fund happens to be a sectoral fund. That is the nature of the beast. They are either at the top or the bottom of the pack. Then I'll get on to this later. The other categories, less than 5 years, a short-term fund will do the needful. And ultra short-term bond fund or a liquid fund can actually take care of your very immediate needs. Short-term parking money for an individual. I'm referring to all these from an individual point of view. And when it comes to fixed income fund, what I was telling you about equity, that you should look at a fund on a full market cycle. I think, what a principle that we have been following at Value Research while analyzing and recommending fixed income fund is that ignore the top performer. The best performing fund, is the best performing fund for a reason, and that reason normally is that it is assuming higher risk, and the problem of risk is that it does not show up every day. Whenever, once in a while, it shows, and it is extremely disappointing. So ignoring the top performing fund while choosing a fixed income category is very important. And then, err on the side of caution, do some checklist. Recent happenings is pointing me to, driving me to think in terms of err on the side of caution, even though the RBI governor says that, we are becoming too risk averse. That's fine. We have seen our capital getting stuck, so it's quite understandable.
I think, Dhirendra, that was, and you talked about one point, which is, and I also feel this, actually my sales head is also listening into this, and he sort of made the point that sometimes the industry is over competitive and we are obsessed with this balanced, best performing fund, when honestly you're just trying to beat goals and, beat some objectives, beating an FD, beating a PPF. I think that's a point that you brought upon beautifully. I want to switch gears to a topic that you talked about and that everyone is talking about these days, which is asset allocation. Of course, everybody talks about it. But if you have to guide an individual, are there some thumb rules and things he should keep in mind when he figures out the right asset allocation for him? Because asset allocation is not standard. It's very, very personal. So how do you think about that?
Yeah, I think that, there are 4 possible asset allocation, and one should try and keep it like that. And it is, there isn't a formula, there isn't a thumb rule, there isn't something which, and of course it is very personal. It is personal because it gets customized to your reaction to different context. If you are really losing your sleep in the month of March, then you need to really revisit what your asset allocation is. If you are looking at March situation as, because, investor's mind or, human mind is malleable. It changes with the context. It changes with the time. What you are angry with, you look back and see that, oh, that was a great opportunity. What you are disappointed with, it does little better, and then you think that, oh, wow. So, it is a moving target. Bringing in some degree of objectivity, and I think not doing an over-engineering on that. So I'll just give you because I have written 2 columns, one which appears sometime tomorrow in the newspaper, coming Monday in the newspaper. I've thought of, 4 asset allocation which everybody should target. One is that when you are in the very early years, think of asset allocation that you have nothing to lose. You need to do asset allocation, and after you have accumulated something and you have the fear of losing it. So what is there to lose when you're starting your 5,000 rupee SIP today? Get started with your tax saving fund. If you're a first time investor, get started with your balanced advantage fund, and don't think in terms of asset allocation. Once you have accumulated something which can be, and that something is also a very relative thing, because that something could be 5 lakh rupee for somebody whose monthly income is 15,000 rupee. That something could be 5 crore rupee for somebody who has a different scale of savings, investment, and aspiration, or whatever. So it's a very relative thing. It's a very personalized thing. The moment the money becomes meaningful and losing it will cause anxiety to you, then I think that is the time when 1/3 of your money, don't actually fuss over this. I think it's 100%, 1/3, half, 50-50, and 2/3. This is my formula. Reason being, and I'll just get to this. Once it becomes meaningful, then you need to guard your capital, because that is when you suffer. That is when you are getting anxious that I've lost this much, or what happens, or if this prolongs, if this excuse me. So that is when 1/3 of your money should be targeted to fixed income. I'm talking about this asset allocation for your long-term money only. Once it becomes meaningful and you want to really get very passive about it, then make it equal. That will be fine, because and when I'm referring to that money which can actually take care of your, you once you have money of a scale where the money can take care of all your future needs, and you don't run the risk of outliving your savings. That is the scale of money which I'm referring to. It could be 25 lakh rupees for some people, it could be 5 crore for someone, it could be 3 crore for someone, whatever it be. Money which will take care of you for a lifetime. If you start consuming some income from that, that is the stage when you should really target 50-50. Then you will get, because the real advantage, real charm of asset allocation is that you can rebalance and benefit from the market madness only if you have an asset allocation and you have the ability to rebalance it. And it also requires, and if you are a conservative person, if you are a person who has much more than enough, and you really don't want to sweat it out, and you don't want that great anxiety, that is the stage when I think everybody should have a fixed income allocation, definitely. So 1/3 of your money should be in equity, 2/3 should be in fixed income. That is a conservative person for you. That you also need that allocation, because that is the only way you will be able to protect the worth of your capital. Without equity, your capital will go down in value and may not be able to beat inflation. So once you have clarity on these 4 asset allocation, why it should be there, and these are meaningful, because there is absolutely no precise formula that it has to be 52% and 48%. I don't think there's any basis to it. Rebalancing rules for you, I think it's very straightforward that, don't sweat over, 2% movement here and there. Keep it, 10%. It becomes 45 or it becomes 55, that's okay. Crosses that, do the needful. March happens, so an annual check of your of your asset allocation is good enough. Now, most importantly, I think, the critical thing which investors miss is their ability to look all their investments at one place, because the way our savings and investments, the accumulation happens, is that we have our, if we are in the organized sector, our provident fund contribution starts. Or if your grandfather actually initiated you to investment, then you will have a PPF account. Then you will have some fixed income fund. Then you'll have some tax saving fund. Then you'll have some LIC policy, which you don't know whether it's an insurance or an investment. So putting it all together, making sure that, you are able to have it at a glance. And I think things have become very relatively easy. It has become possible. One is that you have your consolidated account statement. If you have a demat account, then all your investments, including mutual funds, get aggregated there. If you are a new government employee who have come in workforce since 2004, then you will have the NPS account, or you will have your GPF or your EPF account if you're a private sector employee. So, having those balances available digitally, keep it handy. You will know that, and the other advantage is that you will be able to have all your finances at one place. They are all digitally accessible, and that is your real asset allocation. Because many a times people are doing a 5,000 rupee SIP and they will have 80 lakh rupee accumulation elsewhere, which goes completely under the radar and unnoticed. One will be, fretting about something else. I see it all the time when the kind of questions that we get at Value Research Online. Aggregate it all together, keep an eye on that, and then you actually start investing and operating with confidence. Having information and having your true scale available at time. And Value Research Online also helps you very nicely in terms of being able to aggregate all of it together.
I think you actually made a point, Dhirendra, that I rarely see in these events, which is that asset allocation starts with actually having it all together, which is something I rarely hear anybody talk about. And actually, very few of us have our investment act together. I wanted to, since you mentioned this a couple of times for the listeners, and we were talking about asset allocation, you mentioned balanced advantage funds and dynamic asset allocation or balanced advantage. My love for this category is known, but since you mentioned it, the fact that they do asset allocation, why do you think this category is powerful, and how do you think investors can use it as a core category in their asset allocation?
One is that I think it's an interesting category. It is actually this category got created as a tax dodge, because we were a country where equity was defined as a fund which invests in 65% and more in equity, and there was a consumer need to have. And initially in India, the balanced funds were 51% equity, 49% debt. Then our tax laws changed. I'm just giving you the genesis of the tax laws and how different funds got distorted, complying with the tax laws. We used to have balanced fund, which was 51% equity and 49% debt. Then the tax laws changed that for it to be treated as equity, which was quite beneficial, or preferential treatment for equity for tax treatment, that long-term capital gains it was free from long-term capital gains. You must have 65% into equity. So every fund actually changed its mandate to have 65% into equity, minimum of 65%. And then then it almost became an equity fund. When SEBI reclassification came, then it became a minimum of 75%. So that is now being called as aggressive hybrid category. We actually lost our balanced funds somewhere in this whole shift towards complying with the tax laws to make it beneficial for the investor. Then the real balanced fund, we don't have any. Balanced advantage fund comes very close to that. I don't like balanced advantage fund erstwhile, simply because it was trying to be that arbitrage position, and trying to look like an equity fund while having the character of a fixed income fund dominantly wasn't desirable. But also I don't like the dynamism of it, because I think ability to have a disciplined asset allocation through a mutual fund vehicle is far more beneficial. If an investor has to do his rebalancing, I will always like a mutual fund to do it for me with discipline, because that is a more tax efficient mode for me, because there are tax implications and paperwork for my annual filing for all those transactions. If you give me a balanced fund which makes sure that it is 50% equity, 50% debt, plus minus 2-3%, I'm saved of all the crisis. And over a period of time, the little bit of difference in return doesn't matter. But so this is it. As I was telling you, that most investors' needs are fulfilled by a defined asset allocation. And most of these balanced advantage funds have also been able to build a good case for themselves in terms of a little bit of tactical allocation, and been okay with that on the margin.
No, and I think that's an important point you make, because asset allocation is something you say you can do, but there are benefits of doing it in a fund format, and this is something that comes up a lot. Now, there are two asset classes, and I'll ask you one at a time. But Dhirendra, I run a basket of international funds, and I have never answered as many questions about international funds in my career as I have in the last 6 months. And the fact is that there is increasing awareness on global diversification through international funds. What are your views on this asset class? Why does it make sense to invest? And if you should, then what percentage should you allocate to such funds?
International funds, simply because India is not the world. Is not the we make investments to look for promising investment opportunity, and the fact that today we are allowed to invest up to $200,000 every year directly in foreign in a foreign market. We have all these over and above that, we have these plenty of investment options available through mutual fund where you can invest anything. India is a very narrow market. and we still have many, and we are a small part of the emerging market of the global of the globe, and there are promising businesses, great businesses, products that we use, and we can't own them. So in that sense, our investment endeavor should be to be investing in finest businesses in a manner, or in a manner that which is palatable, which we don't understand. So a diversified portfolio. Today you have these vehicles available. So I think it's simply the promise of investment. Then the reason for diversification is the same. The reason why you invested in a mutual fund to diversify is the reason why you should invest in an international fund. Then comes then there could be nuanced issues. The kind of product that we use today in a globalized world. When I look at my in front of me, behind the camera, is a laptop, which is Lenovo, which is using an operating system which is Microsoft, and I use an iPhone, and so all the kind of products and services which we are using, how do you own it? Amazon, we have got used to it. Can you own it? So in that sense, diversification through in other markets, in promising businesses, is the reason. And and more importantly, diversifying now is more important in this globalized world, because we have our jobs here, and we have all our assets here, and we have all our investments here. So have something which is under, not direct, and it just violates that principle. But I think most importantly, for this to work, it must be promising investment. So you must invest in international, but don't lose the sight of the premise for a promising investment. That is core.
I think that's, you made 3 points here. One is that there are good investments and bad investments, international and domestic, and make sensible investments. And make them for 2 words, which you said again and again: diversification and access to different things. So I would reiterate that. Dhirendra, can you also give your quick take on the other asset class, which is glittering a lot, and how investors should approach this? And that is gold.
It's quite embarrassing to be saying about gold, because I've said it for so many years and I've been wrong. I have always thought that it is not an asset. It is an asset, but it's not an investable asset class, because my understanding of an investment asset class is something which is productive. When I lend my money to somebody, it is going into the wheels of economy, in terms of some business or some product or some project is getting financed. When I invest in equity, I become a owner. I'm not buying a sticker, or I'm not buying a paper. It is getting into the productive economy. Even when I buy a home, I end up living in it and saving rent, or I rent it out, so it is being put to productive use. This is something which actually, it's entirely dependent on a future buyer willing to pay more for it. And the damn thing sits in my locker. And the character of gold has changed over the last 5, 7 years, 10 years. The financialization, the way you can buy ETF, the way you can buy sovereign gold bonds, or so it's no longer that jewelry. Of course, there are multiple ways of owning gold, in terms of buying the jewelry, buying the coin, buying the bar, buying the gold ETF, and buying the sovereign gold bonds. Everything else costs money. There is a making charge, there is a transaction cost, there is a purity cost or impurity cost, or there could be all kind of things. And then there could be transaction cost, or there could be expense ratio of a ETF, and there could be an expense ratio of a gold fund, which in turn invests in gold ETFs, or but the sovereign gold bonds, where you are trying to de-risk yourself from the government, and here the government is issuing a sovereign gold bond. So I would say that look at gold differently. Look at gold as an insurance to you, and otherwise it's a store of value. It has a much longer history than all the financial investments we have thought of. I mean, it's embarrassing, but I still hold my views, and I still think of gold exactly the way I was telling you, that it's an unproductive asset which sits in your locker. So generally, it should be avoided. But if at all you are convinced of gold, think of it as a store of value and more so now, when we see great deal of anxiety every 5, 7 years, 10 years. Gold finds favor. everything else is crumbling. So gold, there are takers, and the financialization has created a whole new demand, and the cyclicality of demand, because when we have panic, gold rises, and it has become volatile, not as it used to be. So right now, people are chasing recent past performance. Look at it like that. If at all you have to have an allocation, then think of it like buying an insurance, a defined part, a small part, something like, a kind of allocation which will, you will find that, okay, 5 lakh, 10 lakh rupee worth of gold should be there. In the worst of times, this will be handy, and it will be able to preserve the value. I'm a little concerned about your ability to preserve the value also sometimes, because the volatility in gold prices that I have seen in the past, which people are forgetting right now, there has been many years of strong negative returns.
I think that's a superb answer on gold, Dhirendra, and especially the point that you made about the fundamental of the asset class, and which is true of all commodities, actually. I mean, there's a case for why even oil or something like that should rally. I wanted to ask you, a slightly tricky question, and you alluded to this, that investors often fall to the recent performance of markets and also to funds. In fact, many of the questions that are coming in are, a particular fund house has done well. Should I invest in 3 funds of this particular fund house because it's done well for the last 3 years? And there's this constant conflict. So what is your advice to investors in how they manage this whole element of greed and fear? I mean, what are the 2-3 tips that you have for investors?
No, one is that, there are different levels at which you have to deal with it. One is that your second question, while I was telling you that, how to choose a good fund and what kind of fund should you be investing in. So as I said, that most of your needs, though there are 32 kind of funds possible, and most companies have it, besides, many other kind of funds that they have. I would say that most investors' needs are fulfilled by one multi-cap fund or a tax-saving fund, or a balanced fund, or a balanced advantage fund. Then comes, how do you diversify? As I said, that look at this full market cycle. That itself will weed out quite a few. Then comes, if you have multiple scales, the right diversification is, and then we talked about international fund. Don't put all your eggs in the same basket. That is why don't put all your money in Indian markets. That's why invest internationally. Then comes, if you have sizable money invested in Indian equity, even for that matter, you have to diversify across style, across people, simply because, there is a great deal of cyclicality around them as well. I have come across, the finest of fund managers who, for a prolonged period of time, they have done brilliantly. They have impeccable credentials, and then they stop doing well. And then there's, and it may not be questionable. It may be quite natural. Nobody has a control on that. There are times, when your hypothesis doesn't work, or the market remains insane for a long period of time. We have this great investor in the world, Warren Buffett, and a lot of people are actually pointing fingers at him that this guy has grown old and now senile, and he can't really deal with it. He's underperforming the index over the 15 years period. So. And then he had for all his life he has not invested in technology stock, and in 2 years ago he invested in Apple, which has doubled in. So we don't have an answer. People go in and out of favor. Sometimes people succeed. So chasing past see a full market cycle and diversify across few good fund managers. Putting all your money with one fund manager substantially is also violating the risk of meaningful diversification.
Fantastic. So what I'm going to do, Dhirendra, is, since it's a Friday evening, I'm going to conclude this question and answer with you and me with a set of rapid fire questions. On a more less appropriate platform, I would have called this Rum with Radhika, but maybe that's not appropriate. So we'll leave it at Coffee with Radhika. And you should be rapid and you should have fire. And I know you're very brutal, so I'm looking forward to that. And I promise you, I will send you a hamper with whatever you like. A basket of mutual funds of your choice. I will send you that.
Let me try my hand.
Okay, so I have 6-7 questions. So if I gave you 1 crore to invest today, Dhirendra, how would you allocate it today?
I'll be spreading over 15 to 18 stocks directly.
No, so okay, I'll change the question. If I give you 1 crore to invest in mutual funds, I'm a mutual fund CEO, so I'll only give it for mutual funds.
And this money is for me to keep?
Yeah, it's yours. It's a gift.
Forever.
Forever, it's a gift.
Okay, so I'll worry about the gift tax to be paid on 1 crore. The rest of the money, because only from siblings, the money coming as a gift is tax-free, or your parents. So one, I'll provide for that, gift tax to be paid immediately, and rest of the money I'll invest in 2 multi-cap funds.
Fantastic. That is a very simple, straightforward answer to this.
And that too, I will spread it because 1 crore is still very meaningful to me. I'll spread it over the next 18 months.
Okay, great. So you'll do it in STP format.
Yeah, I'll invest in, I'll put equal amount of money in their respective short-term debt fund and do a STP into 2 multi-cap funds.
Fantastic. Okay, since you've been in this industry since 1990, what's your one biggest learning this industry has taught you?
Don't sit on your learning. Everything changes.
Everything changes. Very, very nice one. Your advice to your 20-year-old self or to young Indians today who want to invest, lots of young people, your one-line advice to young investors.
Start now.
Start now. I would highlight and underline that. Start now.
And automate it so that, it just gets out of your bank account.
Automate it so it gets out of your bank account. Young people, this is a good one you should listen to. Okay. The best product or feature that the MF industry has created?
Open and fun.
Okay. Any specific categories of products that you like or features? Anything in the last few years that's excited you?
No, I actually, think that if the fund industry closes down, 35 kind of, of the 32 categories that we have, if 25 categories are closed down, people won't mind it.
I actually kind of agree with you on the categories. Okay. One thing investors should do more of?
See their investments less often.
See their investments less often. Okay. One thing investors should do less of?
Okay, I think I've answered this in my earlier thing. They should, one is that chasing past performance is a disease. And it's very difficult and it drives you off track. So less often and, not chasing past performance. So look at, what I was telling you that this rule of looking at full market cycle, think of that as just your starting point. And that will change your perspective. And if, sorry, can you repeat your question so that I can be a little more specific? I answered the opposite of that in the previous answer.
So my question was one thing investors should do less of.
Don't come to value research to, look at 3-month return, 6-month return every day.
That's a fabulous answer. So, from the person who runs value research, you are saying don't come to my website to look at 3-month returns every day. I would highlight that again and again. And then, so the last, and this is a tricky one, but there's no compliance here. If I made you the SEBI chief for a day, Dhirendra, what is one step you would take for the benefit of this industry and investors?
I would say that, anybody who has an Aadhaar card is KYC enabled.
Anyone who has an Aadhaar card is KYC enabled. Okay, one more question that comes in from my team.
That will actually make it 130 crore Indians as an addressable market for you.
Yes, because we are just 2 crore today.
Yep.
Okay, and there's a last rapid fire from my team, which I'm going to take. Your one word or one line take on Robinhood investors.
I think it's, I really don't, I don't have a one line. I can actually give you a paragraph, but I think, this is a price of learning and I encourage them. I learned it this way too. In 1990, most Indians used to invest in IPOs.
So this is a way to learn.
This is a learning. This is a cost of learning. And in investing, you don't learn from other people's mistake. You have to lose your own money.
Fantastic. Okay, super. So again, Dhirendra, thank you so much for joining us today. It was a delightful session. So many questions answered. Fabulous.
Thank you. And it was a great pleasure being here.
No, and a great line that don't go to value research every day to check 3-month returns. I think that is my takeaway from this line, and that should be the takeaway from all of us for the session. We'll bother you again and again because it was just a fabulous session.
Thank you. Thank you, Radhika.
Don't forget to tune in to the next episode of our Money Connect podcast. Further, these podcasts are also available on Edelweiss Mutual Fund website, Spotify, Apple Podcast, and Google Podcast for you to listen, learn, and enjoy as per your convenience. For further information on one-time KYC process, list of SEBI registered mutual funds and redressal of complaints, visit our website. An investor education and awareness initiative of Edelweiss Mutual Fund.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.